Hi to everybody who has joined. This is John Selig of WaveEdge Capital. We are going to be discussing at a high level valuation decision making in early stage biotech investments. We're just going to go through a quick introduction of my background and the presentation goal. We'll talk about some valuation approaches and methodologies, which is very important as you're thinking about either on the investment side, if you're planning to invest in an early stage life sciences company, and if you're instead on the inside as a CEO or on the board, how you might present yourself to different types of investors and what types of criteria might they be thinking. And then at the end, some thoughts that, again, you as the investor are going to want to ask, and if you're the CEO, that you're going to want to be able to answer. In general, by the way, as we go through this presentation, please feel free to ask questions as we go. The moderator will take your questions and then ask them. I'm sure that other people who are on the call will have the same questions, so they'll be grateful for you asking at the time. We'll also have some time at the end to have a Q&A session about anything that I've discussed. And then we will talk about the sponsor group, Balanced Pharma, of which I'm on the board of. In terms of my background, I've been in life sciences for over 20 years. I was originally part of a global management consulting group. My current investment bank, WaveEdge Capital, focuses exclusively in life sciences and healthcare, mostly in the lower middle market. And we close deals across the space, so pretty broad focus within that space. In terms of my specific background, we worked with a lot of the biggest pharmaceutical companies in the world. Most of their current portfolio strategy methodology is based on my former management consulting firm's approach, strategic decisions group. We worked with Pfizer, J&J, Genentech, Amgen, Abbott, you name it. I also lectured extensively at different groups, including Genentech, the biotechnology industry organization's annual lecture for their executive training program, and also to the members of Stanford Medical School for their entrepreneurship program. I'm a former mergers and acquisitions lawyer at a large New York firm. And as mentioned, I was in management consulting for quite a number of years, doing valuation and strategy before going into investment banking. So again, please feel free to ask questions while we go. ID here today is have a high level view of different approaches. It's a pretty complex area, so we'll try to keep it at that high level. Really important to also understand the difference among different assets, understand what you're either, again, if you're the investor investing in versus if you are the CEO, what are the differentiations around your asset? What's the nature of your asset and how is that going to be attractive to different investors? And really to start understanding what questions you need to ask when you're considering a biopharma investment, and as the CEO, what you should be able to respond to. So valuation first. Why is this so complex? It tends to be, by the way, very backloaded. So there are multiple factors that enter into any valuation of particularly a biopharmaceutical asset, which is what we're focusing on here today. Incidentally, a lot of this also applies to medical devices. So for those of you who are in medical device field, you'll recognize a lot of this. Fundamentally, if we think of two of the major areas that venture capital firms invest in, one is really on the tech side. one is on the life sciences side. They're quite different. In fact, in a lot of areas, they're almost diametrically apart. Um, in terms of different characteristics, cost to get to market, if you're in the technology side, it's far cheaper in general. In fact, some apps only take a few $100,000 to get something that is ready for market. But at the very least, once you have spent several $1,000,000, you have had enough quality control and review to have something that actually is commercially presentable. As a result, if you are on the technology side, a lot of your timing of cost and risk are backloaded and has to do with commercialization. Basically, if I build it, will they come? Will people care about it, given there are all these other competitors already in the market? Maybe I've come up with something new, but how deep is the barrier to entry? It's a pretty quick time to get to market, but the market changes pretty rapidly because of new companies coming in very quickly. So part of the risk also is, how do I keep my company, my product relevant? I know I can get to market. I can solve whatever issue I am trying to figure out. The question is, will it matter once I'm in market? And so investors who go into this space are looking for that quick time to market, adaptability, ability to pivot, and some ability to defend your differentiation and prove yourself among the other options. In direct contrast, in life sciences, particularly biopharma, you have two major types of approaches. One is the NCE, which means new chemical entity, and that's the classic biopharma, new biopharma asset. That means it's a completely new composition of matter. It's a completely new material. It's also called API. And what that means is nothing has been made with that and is on the market. And so as a result, you need to do extensive testing, both of whether it works and also whether it's safe in humans. And as you can imagine, that takes years. It takes enormous amounts of money generally, and it's highly risky because there are a lot of things that can go wrong in untested assets. So as a result, the cost is mostly upfront. It's in developing these products. Yes, there is cost in commercializing them once you get on the market, but for the most part, a lot of that cost can get covered by very, very good margins and by a relative lack of competition, depending on the area that you go into. The risk is front-loaded in the same way because you've got preclinical trials with animals and then a series of phase 1, phase 2, phase 3 trials in humans, but that both are expensive as well as risky. And things go wrong where you have no idea where they're going to go wrong for some of these trials. It takes years to get from an early identified molecule to a actual approved product. By the way, a question has come in: where would a diagnostic fit into the current cost and time to market? Great question. I have a friend who was the former head of pathology at UCSF and is now starting a diagnostic company. It's about midway. So diagnostics generally can get approved more quickly than pharmaceuticals and get to market more quickly. There is a different path forward for how they're used, whether it's research use only versus being able to used for humans. But in general, I would say it's probably midway between what a tech is and what a biopharma is in general. And hopefully that answers the question. And there's a lot more depth behind that, but I'll just keep it at a high level.
John, I have a second question. What drives the value of a bioasset?
Well, so great question, and that's what we're going to be talking about today. Fundamentally, they vary enormously. Any given asset could get on the market and do 20 or 30 million dollars a year, or could do multiple billions of dollars a year. When I was part of the team that was advising Pfizer in the late 90s on the valuation of Lipitor, which became the biggest pharmaceutical in history at that time, we created a valuation that even we had trouble believing, but it used everything logically. We made the right decisions. We went through the right processes. We came up with a product that was showing peak sales of around $5 billion per year. And the margins on these products are incredibly good. They're mostly over 80% operating income margins. So including marketing and sales costs, including manufacturing costs, they are just absolute cash cows. And it turns out, and we actually had strong skepticism from senior level management at Pfizer. And as it turned out, Lipitor more than doubled that, and I think went to about $12 billion peak. So the answer to the question is it enormously is variable, and that's why it's so important to think about how you're valuing the asset. What is being used to value the asset? What attributes are being used? And we're going to go into that in a moment.
Okay, thank you. If anybody
One
else has questions, please post in the chat.
One small side point, if you look at the bottom row on this page, 505(b)(2)s are an alternative pathway to market. They, as opposed to being an NCE or new chemical entity, they are already well characterized assets. They are simply assets that have been approved by the FDA that are now going to be used differently, or have other aspects or items added to them that make them a better product. So, for example, it could simply be changing the regimen. There's an anti-infective called azithromycin. A major company came up with reducing the number of pills you had to take to 5 pills. It was called Z-Pak, and it was a blockbuster. Blockbuster meaning it went to over $1 billion a year in sales. So small changes to assets that already are proven to work can have a big impact on their value. And again, it can have to do with improved safety, improved efficacy, easier dosage, you name it. But what it means is it tends to be a lot cheaper to get to market because you don't have to go through the same set of extensive trials because the product is considered safe. And it takes a lot less time as a result. And the real question that you want to ask is, how differentiated is this product going to be versus the products that are already on the market that are similar to it? Because often those products will be generics and therefore much cheaper. So this product has to have a defined differentiation to be interesting enough for doctors to prescribe it and people to want to take it. Next question. Or sorry, next slide. So how much of this can you quantify and model, and what would that look like? You need to have a methodology that's credible and validated and taken as seriously as the company's core science development plan. In other words, you don't want to use a methodology that no one else agrees with. It doesn't help you because you can't explain very well why you're coming up to the valuation that you're using. And what's critical about valuation is transparency and being able to have people understand it. You want to create an even playing field so that people on both sides of the table, whether it's the company and their investors or the company and their buyer, understand why a product is being valued the way it is and can understand from their own perspective how that product might fit within their own portfolio.
You see the question in the chat box there, or the Q&A?
Oh, I just saw it. Let's see. Does a 505(b)(2) need to be for a drug with an existing marketing authorization or used for a drug that has completed phase 2 for a different indication? I believe no, but I am not a regulatory expert. But if it has not yet gotten FDA approval, I believe you still need to go through the full NDA process, showing safety and efficacy for the new indication. And then there was a follow-up from the same light, 505B, would a diagnostic as breakthrough status be faster? Again, guys, I wish I was more of a compliance expert. I don't want to give you the wrong answer. My understanding is yes, generally if it's breakthrough, but I guarantee you that the compliance expert is going to have their own ideas as to whether or not that's the case. Just to be clear, guys, my background is primarily in financial valuation and corporate growth strategy. So the good news is, though, this is a lot easier to learn. You don't have to be a PhD in order to understand the nature of what the value of the product is, but you do need to make sure that you can rely on good information. And maybe that good information is because you know the team and trust the team and are able to see what they're saying is the truth and they've well characterized it. Or alternatively, maybe you have an advisor who is someone who has expertise in looking at clinical trial results and can say, yes, this actually makes sense. We're going to look at a few valuation methodologies quickly, with the idea being that some of these are the most commonly used. There are a lot of other valuation methodologies, but these are the most commonly used within life sciences. Sunk cost, comparables, discounted cash flow, and its very close cousin, risk-adjusted net present value. Sunk costs is basically saying, we're going to value your company based on how much money you've put in. What's great about it is that it's very verifiable. You can tell how much money has gone in. And what's nice for an investor is it's a guaranteed multiple on the amount that they've put in. The issue is it's a lousy way to value assets generally because it completely eliminates, for example, companies who have been very efficient with their money and how far they've gotten with a small amount of money. It actually punishes them and it rewards those who have been really sloppy with their spending and have spent it on a lot of items that weren't very important and had nothing to do with the final product. It also caps the upside. My experience has always been that when I've represented a company and a buyer has come in and said, we'll just simply give you X return on the money that's been put in, that it's almost 100% of the time they understand how valuable the asset is and they're trying to get a deal. So in general, I would not suggest this as a way to value a company. And if someone is using it, I would just recommend be suspicious because it has nothing to do with the value that the group who is running the company has come up with. It is often not necessarily related to the amount of money that they've put in to date. Comparables. So this basically derives both either the value of the company or the value of an underlying product by looking at what's already out there on the market. So I've got a new cytotoxic oncology therapy that's in phase 2. Can I just look at another phase 2 cytotoxic therapy? Well, not really. On the plus side, you can get sales data of what's on the market, and it saves you a lot of time because you don't have to create detailed financial models to try to guess at what the value of the product is. But the problem is, how good is that comp? Is it really an appropriate comp? Are the profiles similar? Are they approaching the diseases the same way? Are they being indicated for the same diseases? Even within oncology, different indications have vastly different underlying patient numbers, for example, incidence rates and prevalence rates. Where are the physicians going to use it in their current standard of care, and how might that change? How that might change over time? And also, by the time I launch this, the environment I'm launching in is going to be very different usually from the environment that I'm looking at right now. There will be new payers, there will be new competitors that have launched, and a number of existing competitors will have gone generic, and therefore their prices will have slipped. So I need to be anticipating not just how things are now, but how things are going to be in 5 to 10 years for the typical NCE. As a result, the issue with comps is they can look very similar and have the you have that old phrase, the book and its cover, but underlying they can be vastly different. The snake on the left has enough venom to kill 4 adults. The one on the right has no venom at all and is really good for killing rats in your field. They're both in the same area. They're both in Arizona, but the Arizona coral snake is the poisonous one. The Arizona king snake is deliberately trying to look like the coral snake. Why? Because they don't want the hawk overhead to try to pick them up. They want the hawk to believe that they're a venomous snake, and so they'll be left alone. So you really want to be thinking about what are companies trying to convey to you? Why all of a sudden are all these tech companies slapping on the phrase AI, over the last 6 months? My dishwasher has artificial intelligence. Be very suspicious when you see something that's very, very trendy that all of a sudden is appearing in some of the opportunities that you're going to invest in. They may be trying to be like the king snake and look like something that they're not. Really try to get underlying what they're doing and what their specific target market is. It doesn't matter that the dishwasher has AI. They're competing against other dishwashers. They're not going to get an AI valuation. A few years ago, it was cryptocurrency. Be very aware of really understanding what the market looks like and make sure that someone is giving you logical, credible, defensible arguments as to why they're different and people are going to be willing to buy them. So what's a better way? And by the way, there's nothing wrong with comps to be used in triangulation. Valuations are often the most effective when you use more than one at a time. But just realize the limits of them. A better way, though, if you only had one way to value a company, is a cash flow forecast customized to that specific asset or to that company. When I say cash flow, I really mean pre-tax cash flow. Net sales minus expenses, getting you to pre-tax cash flow or operating income. That is when you hear people talk about EBITDA. That is typically what they're focused on. It's a way to create, again, an apples to apples approach when you're comparing companies. And it takes into account a lot of variables such as, well, these two companies are each selling $100 million, but one has a 50% margin, one has a 10% margin. The 50% margin is worth far more because it has so much more cash flow. Cash flow matters more than sales generally because it's what you get to bring home. So you want to use cash flow as the key metric. You want to see it over time. You want to understand how long it's going to last. So at what point do I believe either someone's going to come in and eat my lunch because it's a completely new but better technology, or my patents are going to run out, and therefore cheap competitors can come in and mimic me and will either push the price down or I'll lose market share. And all of this is built into long-term valuations of life sciences assets. Generally, we value the entire life cycle of the asset from pre-launch to launch, ramp up to peak, time at peak value, peak market share, and then the ramp down after the loss of expiry. And so you get a complete view of what the asset is going to be worth. What that tells you is you really need to know key things such as, are there patents protecting the asset? How long do they last? When do I think the asset's going to get to market? Why might it be delayed? How much is it going to cost before then when I'm not earning any money? And then how much is it going to cost while it's on the market? Do I need to, for example, buy big advertisements in People magazine because I've got a new statin like Lipitor? Or is this a really focused area in a rare disease where instead of focusing on lots of patients, I'll have low volume and very, very high costs, which, by the way, is the current trend in the pharmaceutical industry. So key concepts here, and a lot of you who are very knowledgeable in the finance area, time value of money concept, which is money now is more valuable than money later due to the concept of opportunity cost and inflation. And that makes it even harder, by the way, for life sciences assets because so much money is front loaded and your payoff is backloaded. So you really have to have a big payoff to offset the risk and the cost that you're spending up front. Risk adjustment, you need to account for the fact that particularly in life sciences, you'll never get to market. You have a product that looks fantastic in mice, but for whatever reason has a brutal safety profile, or just doesn't do well enough in trials compared to what the standard of care looks like. And that happens all the time. That is why most products in preclinical never make it to market. They fail on the way. Last is net present value. This is simply the methodology used to incorporate all of these different pieces. It incorporates what that cash flow looks like over time, both negative initially and positive downstream. It accounts for discounting over time. And then again, if there is a risk of even getting to market, it risks adjust for that.
We have a question for you.
Yep, I see that.
How do life science companies in the early stage get evaluated?
So, and that's what we're going to be talking about. It depends on who's looking at it. Number one, there are a lot of frustrating slapdash approaches to early stage valuations where people wave their hands and they say, I can't value this. It's too uncertain. It's too early. So I'm just going to slap on a standard valuation for all assets in the preclinical stage, for example. And people do it. And it saves everybody a whole lot of time, and then everybody moves forward. I guarantee you it is far more valuable for the investor than it is for the company. And the reason why is each of these companies, as I've already described, has enormously different value propositions with enormously different NPVs. So their value should be different. That should be reflected, in my view, in the valuation early on. There are some things that you're going to be able to guess at, such as how big is the market, what are maybe some of the standard attrition rates for products moving through human development, clinical development trials, and what is an appropriate discount rate for a company at this time. You'll have to guess at what do I think the label of the product is going to be when it's on the market. How superior do I think it's going to be compared to the current standard of care? But that's part of the uncertainty there. It's still worth saying, what is this going to be worth when this thing is eventually sold or licensed? Because that's where I'm getting my return on my money. And for the CEO, that's where my shareholders get their money back from. And so as a result, you really want to be customizing this to the individual asset. So to answer the question directly, there are some groups that will simply put a one-size-fits-all approach on early stage assets. And they'll just say, look, you're in preclinical. I'm going to slap on a $10 million valuation. I'm not going to look at anything other than I think there's an opportunity here and I think you've got a good team. Let's call it a 10 million valuation and move on. And then there are other groups that push back at that. The only way to push back at it really is if you're a CEO, is if you have multiple interested groups of investors. And at that point, you can create more of an auction to get people to roll up their sleeves and do a deeper dive into your asset and have a better sense of really why is this asset more valuable and therefore might be worth having a valuation of 25 million or 50 million. And then there are other assets that will go in at 250 million. I'm sure you all have read about some of the AI assets out there that are being valued enormously, even without making money. It is really important to understand what the basis of the valuation is. How did people get there? It gives you basically an arbitrage opportunity. If you're smarter than the people who are assigning the valuation, you can make better decisions as to which assets are better for you to invest in, which companies are better to invest in, so that you have a better chance of a positive outcome. And that really...
A follow-up question?
Oh, yeah, sure.
How do you think about valuing life science companies in places like China? And how do you validate data and claims about data, business fundamentals, and et cetera?
It's incredibly tough. Guys, that's going to be the case for any area of the world that has a totalitarian government. At the end of the day, if you don't have a free society, you don't have free research. Everything, and we saw this, during COVID as well. If you have a government that is determined to control all information, like China's is, I think you're running a risk by depending on research that comes out. Now, if you know the researcher, you have your own people who know the researcher, maybe they participated in the research so they can independently verify the data that came out, that's different. But most early stage investors don't have that ability. You have additional issues, which is, well, what is the value of the patent in China? There have been intellectual property issues in China in the past. Why do I know this one is going to be defended? Who does the team in China know in the levels of officialdom who can help me negotiate the defense for my asset in China to not just validate the claims, but make sure it gets used appropriately? I would just say you are rolling the dice more so than usual when you're in a country that doesn't have a rule of law that defends science and data and intellectual property. That is not the case, by the way, when you're looking at, for example, most of Western Europe.
So how do you validate data and claims about data?
I think you need to have an expert group that can independently look at the data, make sure that it's the correct data, know the people that were running the trials, and individually validate the data and the claims behind the data to say, okay, yes, I agree with that. There is statistical significance here along the endpoints that we have chosen, and they use the right kinds of patients, and ask the right kinds of questions. Basically, was it a properly run trial? I trust the third party pharma services group, the CRO that ran the trial, for example.
Great, thank you. And we have 5 minutes left.
Oh, okay. Sorry, guys, I gotta really rush. So, pushing forward towards discounted cash flow, fundamentally, the benefit that's here is you now have customized analysis of the asset itself. You're taking into account what is the indication? What is the nature of the underlying asset? Who does it compete against when it gets on the market? What are the likely probabilities of success to get through different stages, given the indication that it's in? Because there's a lot of statistics relating to probabilities of success for anti-infectives versus oncology products versus immunology products, for example. Is it a large molecule? Is it a small molecule? Is it an NCE? So it's much more risky. Is it a 505(b)(2)? So generally it's going to be less risky because it's already been well characterized and has a lot of safety data behind it. How much is it going to cost to get to market? All of those things can be baked in when you have a customized analysis. What you also want to do, though, is separate out what a lot of Wall Street analysts used to do, which is munge together the cost of capital, the discount rate, with stage probabilities of success. And the reason why is because these stage probabilities of success vary enormously between different indications, types of molecules, both NCE versus 505(b)(2), large versus small, etc., that you can actually piece them apart and have a better sense of the value of the product. And on top of that, what it lets you do, and you can see this in the graph on this page, is look at the step-up value of the product as it gets through the different phases. And you can see how enormous the change in value can be as you pass through these different stages, both because you're resolving risk, you're also resolving cost, and of course you're moving nearer to market. So that's why it's superior to DCF on its own. You want to be able to see that step-up value, but both of those approaches are more valuable generally than just taking the comps approach. Which methods do pharmaceutical companies, these are the ones who are going to buy the company eventually, use? Not surprisingly, they tend to use discounted cash flow and RNPV. They have huge commercial teams whose job it is to look at products this way. But again, as an investor, if you look at the company this way, you're looking at it the same way that the eventual buyer is going to look at it. That's very powerful because now you're looking at it from their perspective and you can see if it's a viable product. There were companies that we would go into where we knocked out a third of their portfolio because it had not gone through the rigorous analysis and was not showing positive net present value at the end of the valuation. What methods do VCs use? They tend to use both NPV and comps. Why? They tend to have fewer resources than the large pharmas. And if you're talking to a VC, they may be saying to themselves, look, I've seen a bunch of products in this area. Generally, they've sold for $300 million. I want to keep the valuation below X because I need to get a 10X return on this asset. That's not the only way that VCs do it, but it is a way to start so that as they're evaluating the 500 different opportunities that they will look at over the course of a year, it's a nice first pass. So important to know who you're talking to. So to wrap this up, key questions for you to ask. You need to be asking or be able to answer as the CEO questions such as what's the size of the current market? What is the unmet medical need? And is your product meeting that unmet medical need? Why do you know that it's meeting this unmet medical need? Have you conducted market research? Are you talking to the physicians who actually prescribe the product? What value is your product going to bring to the table if it's more expensive? It has to justify that value, particularly if it's going to be reimbursed by third-party insurance companies, who otherwise are going to have a very cheap generic that they can push patients off to. You have to have that argument in mind when you're thinking about investing. Make sure that they've got strong intellectual property where appropriate, particularly if it's a life sciences product. Have they filed the right patents in the right geographies? How long do those patents last? How strong are they? How easy will it be for someone to make a runaround? The CEO should have very strong answers to all of these questions. And by the way, can they continue to create new IP to continue to extend the defensive moat around the product and potentially to expand into other geographies? funding, what milestones? Go back to that step-up value that I showed. What is it going to take to get to the next milestone that will have a meaningful step-up value where risk will be resolved, they're closer to market, and they've resolved some of the spending? How much will it take? What's the risk of getting there? How long will it take for them to get there? And that again should be customized to this product because it's so variable within different therapeutic areas. So summary, make sure you understand the asset that you're looking at. All biopharma products are not the same. There's a big difference between an NCE and a 505(b)(2), but also there's generally a difference between these and tech assets. They're very differently evaluated. Make sure you understand the underlying nature of the product, and make sure you understand when someone is telling you, here's the valuation for raising money at this product, what was the underlying approach that they used? What are they using to justify it? All done.
Great, John. Thank you for taking time. With that, we'll go ahead and close it out. John, if you could, there is a question in the Q&A box that you can answer by typing in. That'd be great for other people to check out. And with that, let's move over to Scott. Scott, if you want to turn on your microphone and video, let's go ahead and kick off with your presentation.
Hi, Hall. Boy, that's a tough act to follow. I'll see what I can do. All right, let's move on from this slide, Jason. I assume everybody on here is an accredited investor. I'm Scott Cato. I'm the CEO of a company called Balanced Pharma. We're making anesthesia better for patients and providers. Go to the next slide. I want to skip that one, Jason. And skip that one. We don't have a lot of time here, Hall, so I'm skipping a few slides. Anyway, the problem that we're solving is dental injections. Nobody likes them. Dentists don't like them. Patients don't like them. Parents of patients don't like them. They hurt. It takes them a long time to work, and a lot of times they don't even work at all. The big reason for these problems, these side effects, is that hydrochloric acid is a preservative in the drug, and it causes all these problems. At the moment, people have tried to figure out a way to get this acid out, but there is really no good current solution. So next slide, Jason. So we've come up with, this is a 505(b)(2) that John was just talking about. And what we did was we figured out a way to get the acid out of the drug. So we leave the acid in the drug and it keeps the shelf life and keeps a preservative. But as you put the cartridge into the syringe, the acid is neutralized. And so you get a less painful, faster acting, and more reliable drug. It's noticeable in all these cases. The shelf life is actually a little bit better. It's got better salt and acid balance. And it works just the same as the drugs that dentists are used to using in terms of duration and depth of anesthesia. Go ahead, Jason. This is just a bunch of research that has already been done on what happens when you take acid out of one of these two drugs that dentists use. And we know from a lot of university research that it's less onset time, less injection pain, and more reliable when you give it. Let's go to the next one, Jason. This just shows us how that works. Now, if you see on the left side of your screen, the standard dental cartridge, which is it's a glass cartridge that goes into a stainless steel syringe, and the needle goes up in there and creates a fluid path. Well, what we did, we changed the business end of that cartridge so that it could contain some sodium bicarbonate, and that's what's responsible for neutralizing that acid. So as soon as you put that cartridge in the syringe, it pops that sodium bicarbonate out, and it's instantly neutralized, and you got a better drug on your hands. Next one, Jason. We did a lot of market research to find out what dentists thought of this. We also asked patients, and we asked key opinion leaders in the dental profession. And we got an overwhelming response. Matter of fact, here's a couple of key opinion leaders, that say, these are innovative cartridges, answer the pharmacological challenges with elegance, and a pH balanced anesthetic and a standard game cartridge will be a game changer. And there's more where those came from. We just can't fit them all on the slide. Okay, here's a great question. What is our regulatory path? Well, again, we are a 505(b)(2). We're simply taking a drug and making it a little bit better by taking the acid away. So it's the same drug, means it's going to have the same safety, the same efficacy. And it's a very short and simple and low risk and low cost path through FDA. Go ahead, next one, Jason. How am I doing on time, everybody? Am I okay, Jason? I'm going fast as I can go. Okay. This just shows, the current products on the market, the fact that some people have tried to make devices that you could use by hand to hand mix and get rid of the acid. They have not worked very well because they've been expensive and cumbersome, and they're not an FDA approved drug. So what we did was, again, we're going to get an FDA approved drug. It's going to have all these great qualities, less painful, faster acting, more reliable, but it's going to be a seamless replacement for the old drug because it's going to be in a standard cartridge. Go ahead, next one. This is just the size of the market. And you see the current market, 744 million units in affluent places in North America, parts of Europe, Japan, South Korea. We don't expect to grow the market, but we expect to take a big share away from the existing generics just because we're so much better. This shows a 35% market share at peak. Again, as John mentioned earlier, it's always hard to guess at those things. We think that's a fairly conservative estimate, but even at 35%, it's a really large market. If you're going to make $2 on 35% of 744 million, that's a big market. Go ahead, next one, Jason. So how do we make money? We can get this stuff made for quite a bit less than $1 a unit. We think we can sell it for about $3 a unit and get that market share that we just talked about. So we'll make more than $2 on each unit, selling to the existing distribution network that is in place and sells to dental customers. We think they can mark it up to about $4 a unit, and that's going to make them 5 times more profit than they make on the generic product that we're competing with. So they should be very happy about that. Then when you go to the dentist and you say, well, when they buy it at $4, what does that mean? Well, we're taking their price up by about 2/3%. So it's still going to be about 1% of procedure cost. And we believe that the return on investment for a dentist is something approaching 7 times their current situation. Go ahead, Jason. This is just one model. If at that 35% peak market share, you can see that global revenue should approach $1 billion at the end of its life here. And in North America alone, I said revenue, I meant income. Income in the case of North America alone should be right at $400 million at the end of its life. Go ahead, next one, Jason. This is a really kind of tough slide to go over in a hurry, but fundamentally, we need about $20 million in equity and about 33 months at least, maybe a little bit more than that, to get to market and get to profitability. Next one, Jason. This is our team. Again, this is a really short presentation time, so I'm not going to try to go into all this, but trust me, there is a ton of talent. It is diverse talent that represents subject matter expertise in every category that we need it in. These folks are all experienced and all just wonderful to work with, and they know how to get the job done. Next one, Jason. And this is our scientific advisory board. Again, experts in all their subjects. We got anesthesiology, pharmacology, oral surgery, general dentistry, and dermatology. Go ahead, next one, Jason. This is just a few of the 100 or so volunteers on our clinical advisory board that represent all the dentists and other specialists scattered across the United States that are enthusiastic about this drug. And we limited it to 100, but we got a really, really good bunch, and even some of them are textbook authors on the subject that we're trying to improve. Next one, Jason. In terms of other life science investment opportunities, again, if you compare this to some of the other stuff that's out there that John was just talking about, it's important to know, we've got a proven market need. We know this from our research. We got a large known existing market also from our research. Very low regulatory risk. That's from feedback from the FDA. A low R&D cost and a fast exit potential because we're a 505(b)(2). No change in clinical practice, which is wonderful. We've got a very ripe competitive landscape. We're just competing against generics, and we're highly differentiated from those generics. Unlike most drugs, we don't have any reimbursement issues. Our reimbursement comes from just from the doctors. So this is again a very low cost, and it's just a direct cost to the doctor, like a gauze pad or a sponge or something. Dentistry has wonderful accessible distribution channels, so that shouldn't be a problem. Got a nice long patent life because we're so short to get to market, and we happen to be qualified small business stock, which I can't cover in here, but it's basically a 100% tax exemption on the capital gains if you hold this stock for a little bit and sell it. Next one, Jason. We might be at the end. Yeah, the current raise, we've got a $500,000 safe. That's I think it's almost oversubscribed now, which is just a 20% discount to our upcoming raise. And then the upcoming raise is a $6 million Series A. And that's just going to be priced equity. Okay.
Great, thanks. If those have questions in the audience, please put them in the chat box. And my first question is, how many months till FDA approval?
We think we can get FDA approval in 33 months at best, and we'll probably slip from there a little bit.
And aside from the $6 million, how much more will you need to raise to get to an exit?
$14 million.
Okay.
No, that's not to get to an exit. That's to get to profitability, Hall. We could get to
profitability.
Next week. You just never know when somebody wants to buy your asset.
Right. And who are potential acquirers at this point?
Well, there's a couple of really big strategics in the dental space. One of them would be a direct competitor. One of them would be getting into the business, but with plenty of capital. And then any of the pharma companies or any PE outfit that was looking into it. I don't expect an IPO in this situation, just because the tax break makes it favorable for an acquisition.
Okay, great. And are you a Delaware C corporation?
We are. Okay,
great. And how long do you have to hold that stock in equity before you get the tax break?
There's a 5-year tax period. So once you acquire our stock, you have to wait 5 years. Whether you possess the stock or not, you can put it aside, for the rest of the tax period. But there's a 5-year tax period. So if you acquire the stock today, it's 5 years from now that you can get your exemption.
Great. And what's the response from the dentists for this deal? What are you seeing out there from the dentists who are looking at this opportunity?
Oh, it's been phenomenal. That's how we've raised our early rounds. We raised with, I guess nearly $4 million now from, mainly dentists. So we've got over 150 dentist investors. And, it's just been a phenomenal response when we ask dentists, now they're small investors. They don't write $1 million checks, but they write $10,000 to $100,000 checks.
And what do they like about it?
They want the product. That's the first thing out of their mouth is when can I get the product? And we go, whoa, Nessie, Bessie or whatever your name is. We got to get the product to the market first. So anyway.
Okay, great. Are there any other questions from the audience? Please go ahead and post them now. We just have a few more at this point. And I guess my next question has to do around the intellectual property. Where did that come from?
I guess I'll brag a little bit and say I'm the inventor, and I have 3 patents, and those Balanced Pharma owns all those patents, and we have a very wide and deep moat around our assets.
Okay. And so, you've got a great opportunity there as well. What's the next step on the FDA path? We talked about 33 months to the approval, but what is the next specific thing you have to achieve there?
Yeah, it's with any drug, you have to first make the drug. You make a very small batch of it, and then you take that drug and you put some of it on a shelf and just let it sit there for about a year to be analyzed after the year is up. They call that a stability test. And then we have to do a small test on animals to make sure it's safe for nerves, and we know that's going to be fine. And then we have to do a small test on just a few humans, just to show that we're trying to get we're going to show proof that it works faster and hurts less, basically.
Okay, great. And I have a question in the chat box. Curious, how did you successfully go about getting all those board members onboarded?
I guess that's some other CEO asking me that. I think I guess I have the sort of personality that when I see somebody that I think is just an expert, I just pick up the phone and call them up. And I think there's more nice people out there than you know about. And if you tell them what you're doing and they like what you're doing, then it's actually a pretty easy job. I think we've actually turned away more board members, than just because I think it's been very easy to recruit help for this project. Everybody wants a better dental shot, and everybody understands the value of all this. So, like I said, I just called what I thought was the best of the best, and I think I pretty much got them. But don't be shy.
With
If
that,
this
we'll
is,
close.
yeah, if that's a CEO asking, just don't be shy. You can't be a CEO and be shy.
Right. There you go. Okay. Well, great. Well, that wraps up our time today. I want to thank you, Scott, for a great presentation. John, thank you for a wonderful presentation as well. I want to thank you guys in the audience for asking great questions, for joining us today. We'll be back for another great 10 event here soon. Keep a watch out for your email. We'll be coming back with more. With that, we'll go and wrap it up for today, and we'll see you guys next time. Thanks so much for spending your time with us. Have a good day.